In this video, I'll show you the exact process I use to prepare for and trade economic data points. The first thing that you need to discuss here though is the elephant in the room. You see, the moment I start talking about trading economic data points, I usually get questions or comments that go something like this. But Arnu, isn't trading economic data points dangerous? But Arnu, I was taught I should always stay away from the red events on the calendar. And Arnu, isn't trading news just a coin toss? Well, if you still believe this, then you have been lied to, just like I was. Yes, trading economic data is dangerous when you are trying to trade it from a purely technical analysis background. Be really careful of those that tries to teach you to stay away from trading economic data, or those that told you it's nothing more than a coin toss, because they have absolutely no clue what they're talking about. But Arnu, you can't say something like that. Well, you know what? I'm tired of all these fake trading gurus that are trying to deceive retail traders and keeping them away from good tradable opportunities. Think about it this way. If trading the news was so dangerous, why do professional traders trade into and out of them week in and week out? Just think about that for a second. If it was such a bad idea, if it was so dangerous, if it was just a coin toss, then why do we pay for a premium, faster than normal economic data calendar? Why do institutional traders pay up to $2,000 per month to get access to Refinitiv and Bloomberg economic calendars? If there was no one that is able to anticipate which direction the markets will move after key economic data releases, then why do pro traders keep on trading them every week? It's because they can anticipate how the markets will move based on certain outcomes. And guess what? It's just not rocket science. But you see, the problem comes back to those that have taught us to stay away from economic data releases. They just don't know what they're talking about. Think about it this way. I know for a fact that I can't run 100 meters in under 10 seconds. I'm just not fast enough. But does that mean that nobody can run 100 meters in under 10 seconds? Of course not. People do it every day. Just because I can't do it doesn't mean that nobody can do it. And it's the same about those that tries to tell us to stay away from economic data. If you don't know how to do it and you've lost money doing it, it doesn't mean that nobody can trade them successfully. It's possible. So with that rant out of the way, let me show you the exact process that I use to prepare for and trade economic data points. Now, the process I use is one that we've talked about in quite a few videos before. We call it our 3-step analysis process. It's simple, it's repeatable, and it's effective. So let's run through this process to show you how I prepared for and traded the 2022 October US CPI release. Let's start with the baseline. Now, we knew US CPI inflation data was going to be really important, as inflation was the dominant global macro theme for many months running into this print. We also knew that the Fed was data dependent from their July FOMC meeting, which meant that US economic data would determine where the Fed goes with their terminal rate. Based on that, and based on the macro fundamentals we were seeing at that time, we also knew that we were expecting a cyclical reaction to the data for the dollar and for yields, and a counter-cyclical reaction for equities and precious metals. That meant we knew that a big beat in US CPI was expected to be dollar and yield positive, but equity and precious metal negative, and it meant that a big miss in the US CPI was expected to be dollar and yield negative, but equity and precious metal positive. Now, as a side note, these reaction functions changes in various economic environments. Hence why it was important to make this distinction heading into the data. Then we can turn our eyes on the expectations for the print. Looking at forecasts, markets were looking for headline CPI year-over-year, core year-over-year, and core month-over-month to decelerate from their prior prints, but for headline CPI month-over-month to accelerate versus the prior. So let's move on to step 2, which was analyzing the surprise factor. Apart from the median consensus, it's also handy looking at the minimum and maximum analyst estimates to get a sense of what numbers were really surprise markets. In terms of the forecast distribution, we saw that the minimum and maximum estimates for headline year-over-year was 7.6 and 8.2. Furthermore, we saw that the minimum and maximum estimates for core year-over-year was 6.3 and 6.7. So we knew a move outside that range would be huge. Now, after that, we can also drill into this with a little bit more detail, looking at the forecast distribution. Distribution-wise, we can see that we had some clear outliers with both headline and core year-over-year estimates. You see, even though our minimum for headline was 7.6 and our maximum was 8.2, we can see from this chart that anything below 7.8 would already be a decent surprise lower, and anything above 8.1 would already be a surprise to the upside. Then moving to the core, even though minimum estimate was 6.3 and max was 6.7, we knew a move below 6.4 and above 6.6 would already catch the bulk of estimates offside. Then it's also worth remembering that the trend of the data is more important than the absolute number. We knew from the trend that even a consensus print for the headline year over year at 8% would see a continuation of trend deceleration. But for core year over year, a consensus of 6.5 will still mean trend moving higher, and we needed core year over year smaller than 6.3 to also crack the trend in core, which would have been huge for markets. Now, apart from the data itself, a major aspect that many traders forget to consider as part of their analysis is pre-positioning going into key events. We knew the dollar traded predictably cyclical in the past 5 CPI prints before October, and there was no reason to expect anything different from the October print. Now, even though the size of the deviation certainly matters, the pre-positioning can sometimes be more important. Notice that the two biggest post-CPI reactions before the October print came from either a lot of offside pre-positioning or strong pre-positioning. For the September 13th print, markets had very offside pre-positioning, which saw a huge dollar upside on just a marginal CPI beat. For the October print, markets had way too strong pre-positioning into the event, which saw initial dollar upside on a marginal beat, but then a very strong sell the fact reaction. Now, heading into the CPI, markets had evened out in terms of pre-positioning, and this was good because it meant that either a big miss or a big beat across the board could see decent directional volatility for the dollar. Then moving to step 3, the bigger picture. We didn't think that either a big miss or big beat would really change the bigger picture, which meant we didn't want to hang onto our trade forever. It was just a short-term trade we were looking for. So what did the actual data look like? Well, it was a miss across the board, and more importantly, both the headline year over year and core year over year printed below the forecast distribution levels, which we knew would surprise the bulk of market participants. And what was the result? Well, exactly as expected in our pre-event prep. We saw equities rip, yields fall, the dollar fall, and gold fly. Our preferred trades was a pound dollar long and a dollar yen short, with both trades getting a horrible fill but still managing to squeeze out more than 100 pips on each one. Now, this was a nice, clear, clean, no-brainer, high probability trade out of key US economic data. And this isn't an isolated trade either. We trade data using this process every single week. Now, based on our process, it does of course mean that we might not get a good enough trade based on the data every single time. But when the outcome gives us a good deviation, it can create some fantastic trades like this one. So I hope this has helped you gain some insight into how professional traders use macro fundamentals, premium tools, and basic intermarket and technical skills to make money trading economic data. If you think this is something that you would like and want to learn more, make sure to check out our website for more information. Until next time, happy trading.